Hi everyone, this is our video on a hedging strategy. A couple of things I will repeat once again, and a couple of questions I'd love you and I really encourage you to think of before you start hedging or you continue to hedging. So first of all, it's currency mix. Okay, I will put the framework here once again, and I will emphasize very important and sometimes not commonly asked questions you might probably need to ask yourself. So first is the currency mix. Currency mix, and what is it about? It's about what to hedge and if to hedge. You should ask yourself, what currencies do you have in portfolio? So this is obviously the first step you're asking and answering that question. For example, we have Australian dollar, United States dollar, euro, etc. And let's say here you have 100, here you have 2000, here you have 5000. What to hedge and what not to hedge? It depends on many factors. First of all, what's your functional currency? Maybe this is Australian dollar or euro or whatever it is. Next, what's the volume? What's your risk? For example, what will happen if the rate will change by 10%? What will happen with your bottom line result? Because I mean, every time you buy hedging contract, it costs you some sort of fee. And maybe it's not necessary to do anything with Australian dollar. But also it might be reasonable to do it if you already have good infrastructure in terms of hedging, you have a lot of counterparties, and it's nothing for you to add additional forward in Australian dollars. So think about it, how important the currency is for you, especially if you have a big list of currencies. If it's 20 currencies, maybe just administratively difficult to take care of all of these currencies, and you should put all of your efforts into the main currencies within your portfolio that might cause a greater impact on your bottom line. What are the other questions you potentially should ask yourself? Okay, that's a good one. I'm always keep forgetting about these, but sometimes you have currencies like Danish Krone, and there are other currencies like this that politically linked to other currencies. In the case of Danish Krone, it's euro, and this is a government policy to make DKK some sort of fixed rate with plus minus 2.5% fluctuation from that rate, and is linked to euro. So it's set its rate against euro, and allowed fluctuation is 2.5%. So basically, for you, it's the same. It's one currency. But here you should carefully check a couple times a year if there are any changes within government policy regarding that fixed rate against another currency. It might change one day, and if you have big exposure here, you might face significant unexpected gain or loss into your profit and loss statement. So it's better to, I don't know, to have some sort of policy, obviously, to have some sort of constant checks against this currency if the policy of the government changed or not. And it should be built as a control procedure. Okay, identify such kind of currencies, put them at a specific list, decide if to hedge them specifically, or is better to hedge the kind of parent currency and use these to fund that particular subsidiary or not. Another question I'm asking, and I keep forgetting about it. Okay, there are a lot of geopolitics. Okay. For example, and it's not only about geopolitics, it's about historical fluctuations and relationship between currencies. If you have United States dollars as functional currency and you see that against Australian dollar, historically the fluctuation is not that big, you might decide not to hedge because it's not, analysis. It's unlikely that you face 10% of fluctuation. But at the same time, maybe it's worth to hedge with some sort of out of money option. Low cost option. For example, if you, I'm working mostly with euros, that's why I will use euro example. If you will buy an option for 1.18 today it's end of May 2026, you will probably pay, I don't know, $39,000 per 1 million euro for the call option with expiration in 1 year for 1 million euro. But if you go further in terms of the fixed rate, let's say 25, your cost will drop probably to 20K. It's not real data, but it shows the magnitude. The magnitude correct, but it's not real data. And if you go to 1.3, it might cost you like 9K. It's worth to consider. A lot of companies use this particular approach. So what do they naturally tell by this action? We don't care if the rate fluctuates slightly. We accepting that risk on our profit and loss statement and cash flow statement, but we want to avoid by any means the kind of tail risk, the risk that it's unlikely to happen, but if it will happen, that will destroy everything. For example, in case of USD functional and euro of that volume, the change to 1.3 might destroy everything, especially for the businesses with low margin. It might cause a lot of trouble. So it's something worth to consider. Currency mix. What are the currencies? What will happen if 10% change will happen with the exchange rate against your functional currency? Take care of politically restricted currencies and politically linked to other currencies, and protect yourself against the tail risk that is unlikely to happen, but if it will happen, it will destroy everything. So this is some sort of what to think of in terms of currency mix. And one thing I keep reminding myself, like, this is strategy, basics are there, it's straightforward, like it's obviously straightforward. Underlying data, you should carefully check underlying data, so your forecast. Do you believe in your forecast? Is it accurate? What is the history? Fun fact, are there any probable events that might happen with the company and you are not aware of? Should you check with the most senior level of decision makers within your company? they know better. They might have already planned some kind of merger, acquisition, or dissolution of the subsidiaries. So, I mean, this one is tricky. This is easy. Just take your time, spend a certain amount of hours to be sure you understand your currency mix, to be sure you play it with different restrictions, policies. Like, create a spreadsheet. It should be simple at a high level. Make what-if analysis, list your instruments available for you. A couple of hours exercise, then a couple of hours of review. But with the forecast, that's, oh my god, that's a challenge. You have to go deep. You have to understand who prepares it, what are the inputs, and if they are reliable enough to jump into the conclusion. Okay, that's for the what to hedge. The next one is how to hedge. Let me list it here. How? Again, this is about available instruments, and it depends on some factors, not many. What broker do you trade with? What is your size? How strong is your negotiation position with the broker? I mean, if you're a big company, you have several brokers, and you have visibility over different types of contracts, you might just send the request to all of them at once, or even jump on the call with all these brokers and see what is the proposal in terms of premium for the options, what is the range for zero cost collar, and what is the cost for the forward contract. So I propose to check all three of these. It's forward contract. Here you're checking all-in rate. And compare. Options. Normally call option for the currency you're hedging. And here it's a premium. Okay, premium, and so you're checking all these positions and deciding with each broker to trade it. So that's kind of sounds simple, but it's strategic and depends on risk appetite of the company, especially with options, because you're paying the premium upfront, and that is something a bit painful usually for the companies. For the callers, it might be zero cost, but if you want to play with the available rate, with the range, remember, collar is the if the rate's too beneficial, you have to obey to certain trade that you have the corridor at which you're free to buy at the market, and you have your protection against the event and rate goes really unfavorable for you. You might pay premium for collar and make it the corridor more favorable for you. But if you check in the zero cost collar with several brokers, you kind of understand better what these guys are pricing you, what are the difference, what their approach. So my proposal is to check all of these with all of your brokers, regardless of your strategy and final choice, if it's going to be forward, options, on collars. Okay, next one is when. When to hedge. Tricky one. My proposal: if you see your budget rate at the market, hedge immediately, because it's already been confirmed by the board of directors or senior level executives, And if you see that rate, I mean all-in rate equals your budgeted rate, just go and lock in and you're fine. You're already good with your strategy. If you don't see the rate, the things is worth to consider. There are a lot of things actually. There are some technical indicators like moving averages, and moving average, I mean for the currency pair, you have time here and you have price here. Let's assume it's Euro USD and it's about 1.2 now, and we are somewhere here, and the rate was like normally, yeah. You constructing 1 year moving average, and it's gonna be like smooth approximation. And you're also constructing 3 months moving average, and 3 months moving average will be not that smooth. The idea here is then 3 months moving average crosses 12 months moving average on its way up. That's a technical indicator to buy. There are a lot of other technical indicators. Go online, check with any AI you are using, and you will find them. But they not usually, often wrong. It's 50-50. Okay, 51 to 31. So use technical indicators. Another one is the cost of the contract. Check if current cost for options and forward is historically high or low. And even more, if you can, check if that price, on what extent that high or low price depends on current market volatility. Because sometimes if the market really volatile during some shocks, normal 1 year forward points for Euro USD kind of 150 basis points might turn out to 300 easily. And if you see this, it's an indicator that now it's not a good time, because investors and banks pricing in that volatility. It usually lasts not that long. It lasts a couple of months and it will gradually return to normal. So that's a good indicator for me. Price of the forward contract for 1 year, if it's not at the historically average level, also taking into account interest rate parity, then I prefer to wait a couple of months and see where the market moves. Okay, there are many things to consider. You should construct for yourself. But the first one is the budget rate. Everything else is the second. If you see that you are not achieving budget rate, then you go to the price of instrument, some technical indicators, some geopolitical expectations, some protection against the tail risk, but the budget rate first. Okay, the last one, trading. Please use multiple brokers. Check with all of them before you trade. Check with all of them when you trade, and compare them unbiasedly. And what I've noticed in my experience, the favorite brokers always change. 1 week, one broker better, another week, another broker better. Even not like this. Then you start dealing with broker, they tend to provide you the best rate possible, and that will be really close to what you see for the futures. So you might compare forwards and futures, and if the rate is close enough, that means that broker doesn't charge you that much on top of this. This is for your first trade, but then they have analysts. Then they see that you're trading with them a lot. They tend to gradually increase that implied commission. So you have to have several brokers, and you must check before every trade which one is better for you. And here, fifth talking point, it's accounting. I believe, and this is a strong belief, that hedge accounting should be done in-house or with external, not dependent on broker, consultant. Some brokers provide hedge accounting for free, and that's for free means that you're stuck with this particular broker. And when you're stuck with this particular broker, they might from time to time add additional points to premium here, add additional basis points to your all-in forward trade, or not provide you the best corridor for callers. When you have your accounting in-house or with external party, my preference is to do it in-house, because in that case you also have a control of your month-end close. But it's freedom, and freedom costs a lot. I mean, literally, it costs a lot. Because when your broker charges you, for example, 20-30 basis points for hedge accounting, on the big volumes, it might end up to be $500,000. So think about it. And thanks for watching me. That's that's everything about hedging strategy. And it shouldn't be complicated. Try to make it as simple as possible, because when you can provide it as simple as possible, that means that you understand everything within the strategy. Okay, see you. Bye.